Hi everyone. So today I really want to talk about the Silicon Valley Bank failure and what the Fed did today in bumping up the rate another 0.25%. So I want to thank first and foremost Angie Vickerman, our preferred lender at Security State Bank. She is amazing and she provided a very in-depth analysis of this for us. Definitely an expert in the lending area, and we would love to connect you with her if you have any lending needs. As far as the talking points for the bank failure, Silicon Valley Bank was really an anomaly. They were very focused on the tech sector, and they did really well during COVID, and they loaned out a bunch of funds, so they were holding a bunch of bonds. As the Fed has continued to raise rates, those bonds have decreased in value. What happened was, in order to balance their balance sheets, they announced a stock sale that created a lot of concern in the banking sector and a lot of volatility in the banking sector. But ultimately, Silicon Valley Bank had never diversified. They'd never taken steps to protect themselves, and so they really were an anomaly. Now, the Fed's response to that, there was a lot of question as to whether the Fed, because of this volatility, was going to go ahead and raise rates today. They did decide to go ahead and raise rates 0.25%. The Fed rate doesn't directly affect mortgage rates, but there is an indirect ensuing effect. So we can expect that rates are going to continue to go up. This means we're going to continue to have less volume in housing supply, at least in the short term, while people come to terms with new rates. I would say the cliche, marry the house and not the rate, still stands true. However, rates are still at historic lows in comparison to the last 20 and 30 years. My parents were paying 15 and 16% for mortgages. So I'm very thankful that we're still at relatively historic low rates. If you have any questions on more information on this or the market or loan information, we would love to chat with you. Thanks.